Hello, my name is Jawad from Jadid Institute. Today we're going to solve an IGCSE accounting past paper, question 1-1, question paper 1-1 from winter 2020. It has 35 MCQs according to the new exam format. Your paper 1 has 35 MCQs and your paper 2 has some structured questions. 1 mark each. You must, attempt all of them, obviously. Attempt the ones you're aware, you know for sure, and then do some guesswork with the ones you don't know, right? Obviously, a mark will not be deducted for a wrong answer, and each guy's answer will score 1 mark. Just go through this at least before the exam. You make sure you go through your instructions. And by the way, you will be in the exam. You'll be provided with a multiple choice answer sheet. So the OMR sheet, if you're aware, you need to circle, you need to fill in, color in the circles, right? Or either that, or maybe it's rectangles. So yeah, just be ready for that. You'll not be expected to circle around here. I'm just letting you know so you get prepared for that. And you need to take the specific type of pencil. All right, let's begin. A trader prepares financial statements each year. What do these assist the trader to do? Okay, a very simple question. Usually this is the first question. Calculate the amount owing to credit suppliers. No, that's such a specific thing. We don't need financial statements for that. For that we need trade payables control account, let's say, because that will tell us how much we owe our credit suppliers. Cash drawings, we don't need that. Perhaps we can use our cash book to identify that. Check the bank statement balance. We need bank statement for that. Make decisions about future. That makes sense, right? We need our income statement and balance sheet and the SOFP, statement of financial position, to make decisions about future, how to change things, right? It's a very obvious answer. It's not challenging at all. The following balances appeared in Hussein's books. What was the total of liabilities? So what are the liabilities here? We have trade payables, that's a liability. We have other payables, that's a liability. Loan to Imran, this is a loan that is given to Imran, right? It's not taken from Imran, so it's actually an asset, right? Bank overdraft, as you all know, it's a liability. So 4,500 plus 300 plus 1,400, that is 6,200. Option B. All right, let's move on. The following account appeared in the books of Mary. That means we're looking at Mary's perspective, all right? Unless the question later on specifies something else. So far, we know that this is Mary's perspective. Do not think this is Paul's perspective. This is Mary's perspective. Paul is a personal account under Mary's ledger accounts, right? It is either under sales ledger or purchase ledger. If you're aware, there are three ledgers: purchase ledger, sales ledger, nominal ledger. So Paul, well, where would Paul be? How do we know whether Paul is a customer or a supplier to Mary, right? So it seems that from Mary's perspective, Paul is a debit balance. And debit balance should mean that it is your asset. It's a receivable, right? So Paul seems like Paul is a receivable for Mary. That means Paul is the customer, the credit customer to be specific, and Mary is the supplier. Just make sure you understand that relationship. Once you do that, then you will be able to answer this type of a question. Once that's clear. Which statement is correct? On 1st April, Paul owed Mary $90. Apparently, yes, that's correct. Because Paul, the customer, has a balance of 90, and we're looking at Mary's perspective. Mary has a receivable of 90. So that means Paul owes Mary, right? Next, we can have a look at next ones as well. On 14th April, Paul sold goods $150 to Mary. Why would Paul sell? Paul is a customer. You see, that's why figuring out the relationship between the two makes it easier. Paul wouldn't sell goods. Paul would purchase goods. Mary would return goods? No, Mary's the one selling. Why would she return the goods? Mary owed Paul? No, because she's a supplier. You see, again, you figure out the relationship, everything becomes easier, right? Which business document is used to update? Which business document is used to update the cash book for standing order payments? Standing order payments, by the way, are automatic payments. When you have some regular payments, let's say your internet bill, and it's a fixed amount, all right? Let's say $100 every month. it will automatically deduct from your bank. You will define that. You will tell your bank to do that every month. All right? It's automatically done. It means you are not giving any check, you're not receiving any check, you're not giving or receiving any receipt. You will get that information from the bank statement. Well, for example, the internet company, they might send you, your ISP, your service provider, they might send you a receipt. That's a possibility, but we get this information from bank statement. You should be aware of that. So things like bank charges, standing order payments, direct debits, we would know about them from our bank statement, right? Next. On 1st March 2020, the bank column of a cash book had a credit balance of 290. Tells us that it's a negative balance. If you talk about negatives and positives, it is a negative balance. During March, checks totaling 580 were received. They would be added. Checks totaling 600 were paid, subtracted, and bank charges 20 were incurred, and they were supposed to be entered in the cash book. And they're asking for what's the closing balance. Well, we'll deal with positives and negatives here. So we start with a negative 290, then we add 580 because that's what we received, minus 610, that's what we paid, minus 12, that's what we paid. So let's put that in your calculator. Don't forget, start with a negative 290. Don't just say negative. Don't just say 290. You must start with a negative 290. Be careful with that. Plus 580 minus 610 minus 12. That's negative 332. So that means in the bank column in the cash book, it is a credit balance. You should be careful about that because they might ask you a question about, let's say, how would that appear in bank statement? In bank statement, negative balance means debit. You have to go back to the chapter and realize what I'm talking about. If you don't understand what I'm talking about, you must revise the chapter of bank statement. Although it has nothing to do with it, but they can ask you that as well. Zinigi prepared a trial balance. The total of the debit column was 225,750 and the total of credit column was 250. Right? There's a difference of 500. It means, okay, so, well, if we talk about suspense account would be 500 credit because that's that's the smaller side. If you want, you can actually solve this question by creating a small suspense account, a very tiny suspense account. That's 500 balance on trial balance, right? Sorry, the difference on trial balance. The difference on trial balance. Now let's try to see what would cancel this. Bank overdraft 250 was recorded as a debit balance. Okay, now what would be? Okay, wait. Actually, this might be it. It was supposed to be credit of 250, but was debited to 250. So it causes a double effect, isn't it? So rather than being credit is missing 250 and debit is actually added with an extra 250. So there we have it. To fix this, basically we will, it is just a recording error. So it was supposed, well, it's pretty, I would say, logical to think about, right? You don't even need suspense account for that. Yeah, suspense account would not be the best approach in my opinion. Just think about it logically. Bank overdraft is a credit balance. 250 was supposed to be credited, but then instead you debit it, so it causes a total difference of 250, right? So do not go for this method. Although you can go through this as well, but it will be more complicated. It will be a more complicated approach. This is very simple. Rent received from a tenant was debited to the rent receivable account. Well, income, when you receive them, they're supposed to be credited to the income account because your cash book will be debited, right? When you receive some income, let's say your bank or cash will be debit, or receivables will be debit, and your income account will be credited. Now, rent receivable account is an income account, right? Because rent goes two ways. Rent is either receivable or it is payable. So to clarify that, we call it rent receivable. We don't just call it rent account. We call it a rent receivable account to specify whether it's incoming or outgoing, right? So in this case, it's incoming rent. It's an income. Well, it is debited to income account. That's not how it works. Incomes are supposed to be credited, and credited to cash doesn't make sense, right? We're receiving cash and it's coming from an income account. Cash debit, income credit. They flipped it totally. They did complete opposite. So there we go. It's a complete reversal. A computer system purchased from Igcse Computers for 1430 had been incorrectly recorded as 1340. So there was an understatement of, let's see, 1430 minus 1340. 90. Understated by 90, your computer. Let's see. And was entered in the stationery account. Stationery has nothing to do with it. Instead of office equipment. There is no entry in office equipment. And, okay. So, first of all, we made a mistake of recording it at 1340. Right? That's one mistake. Another mistake is we entered it in the stationery account. Obviously, we must have debited it because it's an asset we're supposed to increase. So we're supposed to debit. This was supposed to be debited. Instead, this was debited. Okay. Step number 1, let's fix the mistake. Let's credit the stationery account because that had nothing to do with it. 1340 credit in the stationery account. It's one of these two options, the last two ones, right? All right, next. What do we owe Ace Computers? Ace Computers is our payables, right? Because we purchased from them on credit, but we only entered 1340 in their account. We need to enter 90 more, so credit by 90 Ace Computers account, because Ace Computers is a payable. Our payables will increase. We mistakenly underestimated the payables, and now we have to fix that. So our payables, whenever payables increase, when liabilities increase, they're credited in the liability account. Ace Computers is a liability account. And office equipment, as it was supposed to be debited by 1430, it is debited. Sounds good, I guess. Let's move on. Kate calculated her draft profit for the year at 28,400. She later discovered the following errors. Rent prepaid by Kate was understated by 1,000. Let's look at that again. Kate calculated her draft profit for the year 28,400. Rent prepaid by Kate was understated by 1,000. You see, the sentence is pretty interesting. Rent prepaid was understated. So 1,000 was actually more prepaid than we thought. You should realize that prepaid rent is not part of this year. You know, calculating profit in the income statement follows the matching principle. That means only the expenses or incomes related to this year will be entered, no matter when they're paid, right? So this prepaid one, because we paid it this year belonging to the next year, it is a prepaid rent. This is not supposed to be part of an expense of this year. This is not an expense, but we have included it because our rent prepaid was understated. You know what I mean? Rent prepaid was supposed to be more by 1,000, and you should realize that rent prepaid would reduce expenses, which would increase profit. Think about it. Okay, take a while, pause the video, think about it. So our profit is going to increase by 1,000 if we are trying to correct it. Closing inventory was understated by 1,500. Should note the relationship between closing inventory and profit, because almost daily I have to explain this relationship to my students. Closing inventory is varies directly with profit. Again, closing inventory varies directly with profit. So if you're it directly affects profit, we can say that actually, because putting it the way I previously put, it's not the right way to put it. So the right way to put it would be closing inventory directly affects profit. All right. So when closing inventory increases, profit will increase. Now, does that mean to increase profit, you just increase your closing inventory? No, you don't do that. But speaking arithmetically, like for example, if you forget to include some closing inventory, it will underestimate your profit. That is the arithmetical effect of closing inventory. Why is that? Do you realize that how do we calculate cost of sales? What we do is we add opening inventory, we add purchases, that increases the cost of sale, the first two, and the third one, the closing inventory, actually decreases the cost of sales if you look at it. Closing inventory decreases the cost, isn't it? And so obviously if cost decreases, profit increases. You get it? So the higher it is, the higher closing inventory is, the more it will reduce the cost. And so the higher the profit. Please, again, this is a deep question. It requires you to think. So yeah, as I said, think about it, and you should. The rule of thumb is you remember that you don't have to memorize, but once you understand, then you can remember that when closing inventory is understated, profit is understated. So to fix that, well, we will add 1,500, right? Because by mistake we have sort of understated this, means we have understated profit. So to correct it, we have to add it back. All right, so that is 28,400 plus 2,500, 30,900. D. Let's move on. What would not be included in a sales ledger control account? Another name for this, which I like to think about when dealing with questions related to it, is to think about it as total trade receivables. All right. So what would not be included in total trade receivables? Cash sales recorded in cash book. Okay, I'm surprised how easy this paper is. So cash sales obviously won't be recorded because that's not part of our receivables. You should remember that sales ledger control account is another name for total trade receivables, and cash sales would not even form a part of trade receivables. So there we have it. Checks received from credit customers, it's about credit customers, included, relevant. Goods sold on credit, credit sales, relevant. Irrecalled debts is also related to credit customers. All of these are relevant to SLCA. This is not relevant, cash sales. A trader debited the cost of repairing office equipment to the office equipment account. What kind of error is that? Pause the video, think about it if you don't remember, because I'm going to just say it. Cost of repairing is the revenue expenditure. This is a capital expenditure. This is an expense. This is an asset. Right? So this is error of principle, right? Principal error. You're mixing up the class of accounts. Asset account mixing up with expense account. Although both were supposed to be debited, but still, you messed up. How did this error affect the financial statements? Right. So it was the cost of repair. It was supposed to be an expense, which we didn't record. We actually counted that as an asset. So by not recording an expense, you overestimated your profit, right? You overstated the profit. And what happened to the non-current asset? They were also overstated because there was no such thing as new office equipment, but we included it as such. So both are overstated. We must fix that. It's an error. An error of principle, to be specific. To be precise, actually. Trader uses the reducing balance method of depreciation. What effect will this have over the life of non-current asset? Depreciation charged evenly over the years, that's a straight line. More depreciation charged in the earlier, that is correct, because in the earliest years it's worth the most. The net book value is the highest. And so the percentage doesn't change. However, the net book value falls every year. So in the beginning, in the starting years, it is actually more depreciation. Right. Rashid provided the following information at 31st December. Machinery at cost, provision for depreciation. That's 31st December. We do not know the year. Depreciation for the year is calculated 20% on the cost. It's a straight line balance. It's a straight line method. This tells us that. After the statement of financial position was prepared, it was found that machinery repairs costing 2,000 had been debited to machinery account. What was the correct balance on provision for depreciation of machinery? Okay, let's see. Oh, this is pretty deep. This one's interesting. So this is what it looks like at 31st December. Step number 1, we need to go back. Right? What we need to do is we need to go back. So what we have done by mistake, listen to me carefully, please. This was not, our assets are not 52,000. It's only 50,000. However, we have taken 20% of that since we are at the end of the year. We have taken 20% of that, right? Listen to me carefully. We have taken 20% of that and included it here. So step number 1, let's get rid of that. Okay? Let's get rid of that. So what is 52,000? What is 20% of that? Let's see. It's 10,400. So basically this amount includes 10,400, which we need to go back a step, basically. That's what I mean. So let's go back a step and let's do 23,000 minus 10,400. That is 12,600. All right, now we're back one step back because we made a mistake at that step. Okay, so this would be now this is an assumption actually. They should have clarified, I assume, depreciation for the year. Yeah, they're not clear that this is end of the year, but this is an obvious assumption, right? So anyway, now we're basically before, like let's say this is 1st January, right? January 1st now. And also now we know that our actual assets are 50,000. And now what we'll do is we will actually calculate 20% of that, right? That would be 10,000, right? and include that here. So that is 22,600. That is the actual depreciation. Well, there were other ways to deal with it, but yeah, this one is okay. There was another way to deal with it. What you can simply do is just take the 20% of 2,000. I think that would have been easier. I think so. Just take 20% of 2,000 because this 2,000 was exaggerated. There was no 2,000. There's no such thing as 2,000, but we have included it. So we have to just get rid of the depreciation provided on that 2,000. That's another way to do it, and I think that might be easier. 2,000 times 20%, 400. Well, this was over depreciated. This 2000 was not supposed to be depreciated. Well, it was. So let's just remove the effect of this 400 and we're good. Now it's up to you which one you want to choose. This one's the longer one, this one's the shorter one, but whatever makes sense to you, just take that one. At the end of his financial year, on 31st August 2020, a trader had prepaid insurance. Prepaid insurance means you have paid for an expense, for a future expense that is your current asset under other receivables. The heading is under other receivables. How will this appear in the insurance account and the SOFP, statement of financial position, previously known as balance sheet? They don't use that term anymore in your book, in your syllabus. So this is prepaid insurance, and prepaid insurance is, as I said, sort of a current asset for you. So it will be a debit balance in the insurance account. All right, it will be debit balance to show it's a current asset. And well, if you know one thing, you know the other, obviously, right? If you know it's a debit balance, you know for sure it's a current asset. It cannot be a debit balance and a liability. This one makes no sense at all. Option D. Even if you know, even if you don't read that, let's say that's not given, you should never go for this option and this option. This combination does not make sense, or this option does not make sense. Assets cannot have a credit balance. Liabilities cannot have a debit balance, right? So these two options makes no sense at all, even if the question was not provided. Let's move on. Question 15. Haley's financial year ends on 30th September 2020. She provided the following information. The financial year ends on 30th September 2020. She provided the following information. So 1st October, the first day of their accounting period. Rent receivable accrued. So well, rent receivable accrued basically means that your rent is pending, that is receivable. So it's an income that is accrued. And accrued income is actually a receivable. It's an asset. So it must be a debit balance. That's what we know first of all. During the year we received some rent, and at the end of the year we have some rent in advance. That should give us a credit balance brought down. Which journal entry will be made? Questions like these I always prefer making T accounts, and I always recommend doing that to you as well. So opening rent accrued, rent receivable accrued, it's an income that is accrued, so it's a 480 debit balance. All right. So we received some interest. We received some rent, which will be a credit entry, 6,800. That's, by the way, balance brought down from the previous year on 1st October. 6,800 credit because income account is credited when received. That's one way to think. Other way to think is bank or cash book will be debited, and that income account, rent received account, will be credited. That's done. Finally, we have some rent that is paid in advance, some prepaid rent, and that is a liability on us. It is not our money, but we have taken some money in advance, so it's other payables for us. Now, balance CD is not what matters. All right, balance CD is not the actual balance. So we're going to put 720 here, and the real balance, which is balance brought down, will be written on the credit side, because that shows that your balance actually is a credit balance. You cannot say your balance is a debit balance because CD is debit. No, it's the BD that actually tells you whether it's a credit balance or debit balance, right? So okay, that's done. Now obviously there is a difference. Even after balancing, the balancing is done. So difference is not because of balancing. The difference is because we need to transfer an amount to income statement. So let's do that. 6,800 minus 480 minus 720, 5,600. So our rent received account debit, income statement credit, this entry. You should know that income statement is credited with incomes, right? 5,600 is, oh, okay, we actually need to give that as a journal entry. So income statement is definitely credited because we're dealing with income, and rent receivable will be debit by 5,600. You know what? You didn't. Oh yeah, okay. You had to go through this. That's one way to think. Another way to think is you received this much this year, while this must be belonging to the, because you see in the beginning there was some amount that was pending. So out of this, some amount, out of 1,600 that we received this year, 480 must be for the previous year, and they have even paid us an extra, right? So that also belongs to the next year. So remove that as well because it's not for this year. So this 480 is not for this year, 720 is not for this year, and this is actually what we received. Remove this, and you will get the answer. Not a very, not the best way to do it. Not the very most. Let's say it is kind of logical, but not the most convenient. You cannot be confident with your answer, while you can be confident with your T account answers, as long as you know what is debited and what is credited. Okay, the balances in the books of Jason on 1st July 2019 include the following: trade receivables and provision for doubtful debts. Trade receivables at 30 June 2020, end of the year, that's beginning of the year, end of the year, were 58,500, of which 500 should be written off. Jason wants to maintain his provision for doubtful debts at 2% of the trade receivables. Alright, so one thing you should remember that whenever calculating provision for doubtful debts, you must always first subtract the balance that is written off as irrecoverable, because that won't be received. That is not part of your trade receivables. So step number one, let's remove that. It's going to be 58,000, right? That is your new trade receivables. Take 2% of that. Let's see. 58,000 times 2% is 1160. And it seems that at the end of the year it is lesser than the beginning of the year, right? So it has fall. What is the difference? 1284 minus 1160, that's 124. So the provision decreased by 124. Now this was, I would say, an okay question. Normally they would actually trick you even a bit more with that. They will say what will be entered in the income statement. In that case, you have to say 124 will be entered as an income, right? That's even a bit more trickier. That even tests your knowledge even more. This one is, I would say, simpler. So for some reason, turns out that this paper is quite easy, to be honest. It's not that tricky. Nirmal sells two products, product G and product H. The following information is provided about his inventory at the end of the financial year. Okay, we have 1,000 units of this product G. NRV is higher than cost. We have 800 units of product H, and cost price is higher in this case than the NRV. It was found that 100 units of G were damaged and were unsaleable. Right? So, well, seems like this is waste, right? So we're not going to take 1,000. We're just going to take 9. They're unsaleable. They cannot be fixed, right? They're not telling us that it can be fixed for a certain price, then we can sell it. No, they're unsaleable. They're wasted. So what are we going to take? We're going to take cost price for this one. Just take 900 times 2, that is 1,800. So this one is 1,800. And, or actually, let's point it out here. This one is 1,800. And H is, we'll take 1.2 for that. So 800 times 1.2, 960. 1,800 plus 960, 2,760. Right. Let's move on. Which items will not be shown in an income statement prepared for a service business? Which items will not be shown in an income statement prepared for service business? Service business does not engage in trading. Okay, that's the bottom line. Remember that, obviously. So cost of sales, gross profit. Okay, cost of sales, gross profit. Profit will be there in a service business, obviously. Wages will be paid. We have to give two options. Gross profit and cost of sales won't be there, because gross profit is found in which section of the income statement? The trading section. Do we have a trading section for service business? No, we don't. So if we don't have a trading section, we do not have gross profit. So that is 1 and 2. It is not part of service business. A trader provided the following information. What was the capital on 30th September? Capital, the opening capital Motor given to the business by trader, capital introduced. This is intro. Personal expenses paid out of business bank account. This is drawings. Cash drawings made during the year. That is also drawings, right? And there's nothing about profit. So what is the capital at the end? Closing capital. That's what we need to find. My students watching right now would realize, I hope they realize that I've given you an equation for this. It is from incomplete records, and I, for some reason, like to call it the magic formula, right? Because it helps you figure out a lot of things. If the profit is missing, you can figure that out. If drawings are missing, you can figure that out, as long as other components are given. So let me tell you that one. So we have, how does that formula look like? It is opening capital, right? That's what we have in the beginning. Capital introduced increases the opening capital, right? So we add the capital introduced. You subtract drawings because they reduce capital. You add profit, and of course subtract losses if there are any. And I think that's it. That equals closing capital, right? So you made all the adjustments to the opening capital, those things that affect opening capital, and then you will get to the closing capital. In this particular question, we do not have profit figures, so this is not part of the equation. But remembering this whole thing will help you figure out any of the missing elements, right? Using basic algebra. So if let's say this is missing closing capital, just put the rest of them, solve it. If capital introduced is a missing figure, identify that, right? So let's plug in our information. 52,000 plus 3,500, capital introduced, minus the drawings of 2,000 equals closing capital, the one they're asking, the one they're asking for. So it's 52,000 plus 1,500 overall. That's 53,500, and that's option C. Let's move on. John and Mark are in partnership. Profits and losses are shared in the ratio 3:2. It's respectively. That means the one that's mentioned first, that gets the first ratio, and then the second one gets the second ratio. John is entitled to an annual salary of 12,000. Remember, partner's salary is basically a distribution of profit. It is not an expense. Listen to that sentence carefully. Partner's salary, interest on drawings, interest on capital, these things are not subtracted from profit because they're expensed out. No, they are actually division of profit, right? Not in a ratio, in specific terms. So basically, John would get 12,000 directly from the profit. You get it? The profit for the year ended was 52,000. How much would be credited to partners' current accounts? What is credited basically is what is entitled to the partner. So what goes to the partner? Well, the profit is 52,000. This 12,000 goes directly into the pocket of John. So this goes directly to John, belongs to John. This cannot be distributed among them. This can be distributed. This 40,000. Well, now let's distribute it. Mark is going to get 2/5, right? The total ratio is 5, and 2 out of 5 belongs to Mark, and 3 out of 5 belongs to John, right? So 40,000 times 2/5, 40,000 times 2/5, 16,000 goes to Mark, and the rest 3/5 goes to John. Confirm your answer makes sense. John has a high ratio, higher amount, makes sense. So John got 12,000 and also got 24,000. That's 24 plus 12, 36. That goes to John. There's only one option. And 16 goes to Mark. If you add it all up, it will add up to the total profit. This is what goes to John. This goes to Mark. This goes to John. Add it all up, it will be 52,000. Or even add it all up, you get 52,000 here. This shows that it is basically just a distribution of profit. Partner's salary as well is a distribution of profit. A partnership maintains both current and capital accounts for each partner. An inexperienced bookkeeper prepared the following account, which contains errors. Owen's capital account. Let's see, what's the problem? Well, there is a debit balance. Oh, sorry, there's a credit balance. That's balance CD That's okay, seems okay. Loan made to partnership, that's not capital. There's a difference. Capital, when an owner gives capital, that's different than giving a loan. When a partner gives a loan, we cannot say he invested more. No, he or she invested more. No, we cannot say that. We can say that they just gave a loan on which they're expecting a fixed interest and a repayment. So loan and capital introduced are not the same. This is not supposed to be here. Interest on capital, well, this is okay if they were not maintaining both the current and capital accounts. In this case, they are maintaining both current and capital. You should know that current account is basically capital account itself, but it is just maintained separately, right? Current account is the same thing as capital account, same effect, but it is maintained separately. So all the movements in partner, what goes to partner, what comes from partners, is entered in the current account. What is entitled to partner. So anyway, this belongs to current account. This entry is fine, as I said, if we were not maintaining both. So since we are maintaining both the current and capital account, let's not put it here. Let's put it in the current account where it belongs. So what should appear as the closing balance on Owen's capital? 100,000. Okay. Z Limited provides the following information. What was equity? Equity, you should know that it's ownership. Different types of businesses have different ownership structures, right? Partnership has capital and current account. The capital section differs. In a limited company, the capital section has all the reserves and capital introduced, right? The share capital, reserves, share premium, these things make up equity. Basically, these things belong to the owners. These are the investments. So debentures, liability, not involved. General reserve, yes, that is part of equity. That belongs to the owners. Issued share capital belongs to the owners. Retained earnings belongs to the owners. Loan is a liability. So that is equity. 30 plus 400. Okay, let's move on. Which statement about preference share is not correct? Preference shares do not have, that is correct. Preference share receive a fixed dividend, that is correct. Preference share have a prior claim before, that is also correct. When business closing down, preference share gets paid first. And also the liabilities get paid first before any ordinary shareholders are paid. Preference shareholders receive their dividend after. Okay, there we go. They're called preference for, to some extent, the reason they're called preference share is because they are preferred over ordinary shareholders when, giving dividends. And when business closing down, they're preferred to pay first. Okay, all three options didn't make sense anyway. A sports club was formed on 1st September 2019. What may appear in the receipts and payments account? Closing bank balance, this can be right. Closing inventory of, no, that will be going into the inventory account. That will go into inventory account or let's say the income statement for that shop, not for the whole club. There is no income statement for the club. There's only income statement for the shop. Might appear there. Depreciation for sports income expenditure account. Subscription in the subscriptions account. The only option remaining, closing bank balance. The manufacturing company provided the following information. What was the prime cost? Prime cost means the direct cost of material, direct wages, direct expenses. Cost of raw materials will be taken, direct wages will be taken. This is overhead, 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 overhead. So 186 plus 75,000. That is 261,000. Let's move on. A manufacturer's work in progress at the start of the year was valued 850. At the end of the year, it was valued 10,200. What was the effect of this increase on the cost of production and cost of sales? So once we're done with the whole manufacturing account, then we make an adjustment for this, right? We add opening work in progress, we subtract closing work in progress. So in the beginning, it was 850. In the end, it is 10,200. Right? Basically, overall, once we're done with our manufacturing account, we'll be adding this, we'll be subtracting this. We'll add 850, we'll subtract 10, 200. Well, let's look at the overall effect of doing that. How is that going to affect our cost of production overall? 850 minus 10, 200, it's negative 9350. Now that's how our cost of production will be affected as a whole. So cost of production will be decreasing, to be specific by this amount, and cost of production goes into cost of sales, so that will decrease the same way. Okay, let's move on. A trader made the following forecast for business for the next financial year. What are the forecast sales for the next financial year? We have the average inventory. We have the rate of inventory turnover, and there we have the markup. Whenever they give you markup, what comes to my mind is this little thing. Let me show you what. Sales, cost of sales. This format, this little thing comes to my mind. Now they're asking a question about sales, but they have given us markup. So they're pointing towards what? Cost of sales. So step number one, let's figure out what is cost of sales. That will eventually help us with sales, because when we have markup or margin, and when we have either cost or sales, we can find the other one. Right? Right. Let's see how this can be done. How do you find rate of inventory turnover? You take cost of sales, number of times, right? So you take cost of sales over average inventory, and that gives you rate of inventory turnover, right? Rate of inventory turnover. So cost of sales, well, the missing figure, the cost of sales over average inventory, equals, in this case, 6. So cost of sales is equal to 6 times 80,000. That is 480,000. Now we know our cost of sales, it is 480,000. We know the markup. Well, markup means it is gross profit as a percentage. So gross profit is 25 of what? As a percentage of what? Is its markup. So it's as a percentage of cost. So cost must be 100 if you're dealing in terms of percentages, right? And that tells us that sales as a percentage is 125. So 125 minus 100 gives us 25. If it's a margin, we will say sales is 100, gross profit is 25. If it were margin. Right, now we can find the sales figure. It will be 480,000 divided by 100 multiplied by 125. So that basically will give you value of 1% times 125 will give you value of 125%. Okay, 480,000 times 125 over 100, 600,000. It is one of those things you cannot miss in your revision. Okay, you must make sure you understand this margin markup, because it is going to come in the exam. You know that for sure, right? So why would you risk not studying this properly, right? Number 28. Kim's trade payables turnover increased. Oh me. Okay, so it means we're taking more time is being taken. More time is Kim is taking more time to pay for trade payables. What is the formula? Sometimes knowing the formula also helps. So it is your credit purchases, or sorry, it is your trade payables over credit purchases, right? Times 360, or total credit purchases. What would have caused this? Kim's customers took longer to pay their accounts? No, the payable is the problem, not the receivables. So customers have done nothing. Sales revenues increased, customer sales have nothing to do with it. Kim took longer to pay her credit suppliers, yes. Yeah, we can say that. Kim took longer to pay her credit suppliers, right? We can totally say that. This option B, Kim's credit purchases increased. Well, we need to know whether payables increased or not, because if purchases increased and payables didn't, that means this will actually reduce. The payables turnover will actually decrease. So for this one, we do not have enough information, but the option D tells you the full story, right? All right, question number 29. A company provides the following information about its rate of inventory turnover. What will explain the change in the ratio? Let's put the formula first. We can say cost of sales over average inventory. So it seems like the number of times it's increasing. So what could have happened is our average inventory might have reduced, or cost of sales might have increased, right? While other remained the same. Cost of sales decreasing? No. that would not, if we don't know the other part, then we cannot say that that would really increase the inventory turnover. Inventory is increasing, it's supposed to decrease to really affect the formula that way, to have a higher amount as an inventory turnover. Inventory has to decrease. Sales volume is increasing. What does that mean? That means you're selling more. When you sell more, your average inventory is decreasing, and we need that. Assuming that cost of sales does not change, average inventory reduces, that will increase the turnover. That should be the right answer. Selling price is increasing. This has nothing to do with it. Even actually, indirectly, it has something to do with it. If selling price increase, it may reduce demand, and that would even lead to a lower inventory turnover. That means our inventory is not being replaced that often, right? This basically tells you how often the inventory is being replaced. So if your sales are increasing, you will keep replacing your inventory. Simple. A company provided the following information about its current ratio. What would explain the changes in the ratio? So first it was this, then this, then this. So it seems like our current ratio is improving, but I think it's improving beyond a certain point, right? It's getting too much. But anyway, I don't know what's the question, so we'll see. What would explain the change in the ratio? Inventory is decreasing. We're talking about current ratio. Inventory is decreasing. That does not have any impact on that. Other payables are increasing. No, that would actually lead to lower or worse current ratios. We're getting better. Other receivables are increasing. Trade payables are decreasing. Look, trade receivables are decreasing. So if we say that trade receivables are decreasing, it does not necessarily mean that we are getting cash, but then trade receivables are decreasing. So overall net effect is none on the assets. So other receivables are increasing. Seems like this might be the answer, right? For example, let's say you have some prepaid expense, right? Or any other receivable that is increasing would have a positive impact on our current asset, and well, that will lead to a better current ratio. Next one. A trader wants to improve his gross margin. How can this be done? Okay, we're talking about gross margin, gross profit. We need to improve gross profit as compared to sales. Reduce administrative expense. That is not even part of calculating gross profit. Not the answer. Reduce depreciation of, again, that's part of other expenses. That comes after gross profit. Reduce rate of cash. Again, this comes after gross profit calculation. Reduce rate of trade discount. That comes before gross margin. This will directly impact the sales, right? You get it? So by not giving trade discount, your sales will increase, sales revenue will increase while cost will not change, right? Obviously, cost will not change. We're not changing purchases. However, we are selling at a higher price, right? Because we're not giving a discount. When we sell at a higher price, we'll have a higher gross profit margin. 32. Zach has depreciated his machinery at a rate of 20% per annum using straight line method at 31st December 2018. The statement of final position included this. Machinery at cost, depreciation to date. That is on 31st December. Seems like that's the end of the year. Zach was considering calculating depreciation at 20% per annum at the net book value, which is reducing balance. Right? So first Zach is taking straight line and then he's considering a change to reducing balance. There is no good reason for that, right? They haven't mentioned any good reason for that. So Zach should actually, okay, let's see what Zach should take. 20% of, what was the original method? It's 20% of this cost, 6,000. So Zach should actually keep applying that based on consistency principle. All right. Consistency is when you have to apply the same policy unless you have a very good reason to change, right? Seems like he just wants to change it without any good reason. They have not mentioned a good reason for that. The financial statements of a business are prepared on the basis that it will continue to operate for many years into the future. By definition, this is the going concern principle. When Marina opened a business, she purchased a stapler for office. She recorded this as office expense rather than office equipment. Right. Which accounting principle? Why did she record it as an expense and not as an office equipment where she would depreciate it every year? Now think about it. When you purchase a calculator, an office stapler, do you really want to think about its depreciation every year? Do you want to pay your accountant for that? No. It's not a big deal. It's just a stapler cost like maximum of $10, I would say $5 to $10. Why would you want to depreciate that, right? So do not include that in office equipment as an asset. Just include that as an expense, and just expense it out in this year. Even if you're using it for the next 5 years, just write it as an expense, of write it off as an expense this year, right? Do not depreciate, because it's such a small, tiny thing. It's it's the materiality principle. It's immaterial. It's not a big deal. It's a small thing, right? That's the materiality concept, where something is too small to really depreciate. Okay. It is, however, it depends on the business size. For any business size, I would say should be considered immaterial, right? What is not an aim for of international accounting standards? So I don't remember seeing this in your IGCSE books, but it might be given somewhere. Anyway, it should be done logically. To ensure accounting standards in different countries agree, we can say that standards means we have the same policy. That's one of the goals of setting international standards. So there's a uniformity in how accounts are made internationally. So to some extent this is true, not to some extent, to full extent it is true. To ensure accounting standards in different countries agree. So different countries of the world, they should follow the same path of accounting. This is actually one of the aims. To establish an organization to set standards in every country? No, not every country separately. We don't need that. Actually, this is not the aim, right? We can say this is true. To make it easier to compare companies' financial statements, again, if they follow the same standards, that's when it will be possible, and that's one of the goals of IASs, right? International Accounting Standards. To reduce variety of accounting practices, again, they all mean the same thing in different words, right? These A, C, and D means the same thing in different words. So B is the one that is not a name. It's the odd one out. Okay, so that's it for this paper. In my opinion, this was not that hard. It was pretty easy. It was not tricky. Usually these questions sometimes get trickier. Let's say 2019 and 21 papers, they get trickier. Anyway, a lot of you are not subscribed to the channel. More videos will be uploaded. So yeah, stay updated. Okay, hit the subscribe button. Have a good day. Bye.